If you're looking into structuring your business, then there are two main options you would investigate: a family trust or a company. Today, I'm going to go through the differences between the two, the pros and cons of each, and which one is best suited for which situation. What I'm going to do is jump straight into it and go through which structure I think is best and how they work. And then what I'll do in more detail later on the video, I'll go through companies and trusts more on the pros and cons of each. And to pick which one is best, we need to understand some key facts around your own situation. And that's why even what I say today, you'll still need to apply this to your own situation. Get the help where needed, whether that is from a tax agent, whether it's from a lawyer or even your financial planner, to make sure you're using the best structure for your own situation. However, let's look at things just from a tax point of view, because the structure you choose will dramatically impact how you are taxed. Now, one other key assumption I'm making in this is that all your income is not PSI, personal service income, and it's just a regular business where you don't have any limitations on who can receive the profits. So if you're making lots of profit, you're making hundreds of thousands, $1 million, you're likely not going to need all this to live on. And this is where a company structure could come in handy, because a company structure has a flat tax rate. That flat tax rate is currently 25% for small businesses. So this means that any profits that are left within the company are going to be taxed at 25%. Now, this is obviously much lower than our highest marginal tax rate, which becomes 47 cents when we include the Medicare levy. However, you might have lots of people that you can distribute income to. So maybe you're splitting income 2, 3, 4 different ways, and all those people have no other taxable income. All of a sudden, under a trust, you could distribute this income to lots of people, therefore splitting it and keeping the overall average tax rate low. So let's look at a couple examples. Let's say we make $1 million profit in our business, and should we have that as a company or a trust? So let's look at the first situation where we have that full $1 million as a company. So in that situation, we might want to take $120,000 each as a wage. So if we do that, we're going to pay $31,867 each, or $63,734 in tax at an individual level, and then the company will pay tax on the remaining profits. So the company is going to pay tax on $760,000 at 25%, so we're going to pay $190,000 of company tax, which will leave us with a total tax of $253,734. That is if we use a company structure. However, maybe we've used a family trust structure in this situation. Well, if we've only got 2 people to distribute to, and if we don't distribute, we pay the highest marginal tax rate as the trustee. So we're now going to split that income 50-50, and now we've got 2 people with $500,000 of income each. So in this case, their tax that they will pay each will be $205,667, which brings us to a total of $411,334. So the trust situation would pay $411,334, versus if we used a company in this situation, it would only be $253,734, which would represent about $157,600 tax savings by using our company method. Now, there's lots of other considerations, such as how much access do people want of those funds, when they want access to them, that you need to apply to your own situation. So things can obviously be very different when we have differing levels of income. Say this business, instead of making $1 million, it's now only making $200,000. So in the company situation, maybe we're going to leave it all in the company. So $200,000 by a flat company tax rate of 25%, we're going to pay $50,000 in tax. So what about if we use a trust in that situation? Well, if we split it, we have $100,000 each, we're going to pay around about $49,000 in tax total. So very similar to the company rate if we left all the funds in a company. But what if now, for our family trust, we have 4 people to split that between? So if we split it 4 ways, each gets $50,000 of income, suddenly they're only going to pay around about $30,000 tax in combination. So nearly $20,000 different compared to the company structure of leaving it all within a company. Or if we had a trust that could only distribute to 2 people. So you can really see your income levels and who you have to distribute is going to dramatically impact which structure you go with. And that's why you need to have that conversation with a tax agent or with a lawyer to get this structured right for you. You need to make sure they're asking and you're considering questions such as who is going to receive the distributions? How much estimated profit do you think you're going to make? Who's going to be the shareholders? Is there going to be trustee companies involved? Who are the beneficiaries? Chat to an accountant or tax agent about these things. Now, if you are looking for an accounting firm to help you with this, my business, Rooshock Accounting, would love to help you. We do a lot of structuring work for clients, and it's one of my favorite things to do with clients because it can be one of the best ways to save yourself some tax in the long term and the short term. So reach out to us via our website. We would love to help you. Now let's jump into talking about trusts in a little bit more detail. So when I'm talking about trusts, I'm typically talking about discretionary family trusts. And the reason they're discretionary is because each year the trustee has the discretion to split the income how they best see. So this means that you can have differing distributions at differing percentages each year. Maybe one year it's 100% and 0%. Next year might be 50-50, 60-40. Maybe now it's 33-33-33 because we've got a new beneficiary. So that is the advantage. We can distribute this income out to the individuals who will be taxed at their marginal tax rate and their individual tax return. So we typically will distribute all the funds from a tax point of view. And that is because any funds that aren't distributed, then the trustee pays tax at the highest marginal tax rate. So there's not normally many benefits doing that. There might be a particular situation where that does happen. So that is one of the key pros, is the distribution of income. Some of the other pros include the fact that you can still get limited liability by having a trustee company on top of your trust. A trust also gets capital gains discount, so you can still get a 50% discount if you're selling assets within the business. And this could be really important if you're potentially going to sell your business. So while that's normally not what you think about when you first start it, if it is business you're thinking about selling, speak to a tax agent first, because there's a lot of small business tax concessions and your structure can impact that. Some of the cons to a trust though is it really does need to distribute all that income in the 1 year. So if you do make $1 million and you only have a couple people to distribute, a trust can be quite costly because you're going to have to distribute that out to the individuals and they're going to pay tax at the highest marginal tax rate. A trust could also have more costs, such as additional accounting fees or potential legal fees if you make adjustments. It also might still have an asset cost if you do have a trustee company on top. And if you're setting up a trust and a trustee company, you're likely going to have more upfront costs because you've got two entities to set up. A trust can't distribute losses, which neither can a company. A sole trader may be able to. I've done a whole video on non-commercial loss rules, so go check that one out. Another thing with a trust, just in general, they can be a little bit confusing for people to get their head around. They do have a lot of legal jargon that you really need to understand if you're going to be involved within a trust. Companies, on the other hand, are also complex, but I do find people seem to understand them a bit better. And that mainly is because they have a flat tax rate. So people know with a company, any profit they make will be taxed at 25%. Now, if they pay themselves a wage, for instance, then that's going to reduce the company profits and the company will pay profit on what's left. Now, a company, of course, is a separate legal entity, so you are getting some legal protection there. This goes out of the scope of what I deal with, so speak to a lawyer if you want to know more or you're setting up them for that particular reason. Now, a company still does have the ability to pay wages out to its owners, who will then be taxed in their personal tax returns. And this can be a great strategy if they've got no other income, because we want to utilize those 0% and really low marginal tax rates. Like anything, there are some cons with the company. A company doesn't get any CGT discounts, so that can be off-putting for people depending on what they're using the company for. A company can't offset its losses against any other income, it just has to roll them forward. And a company also does come with an annual cost. So you've got the annual ASIC fee. I think at the moment it's $303, keeps going up each year. And you will likely have more accounting fees because a company is a more complex structure, it requires its own tax return, and therefore your accounting fees are likely to be higher. If you do choose to go down the path of operating through a company, you really need to understand how you're going to pay yourself. In this upcoming video, I talk about how companies pay their owners. I'd love for you to go and check that one out, and I thank you for watching this one.